We'll get started in few moments. So this webinar is happening on the International Investment Awareness Week 2023. And we have come up with a topic, it's Empower Your Financial Future, which is going to be a learning experience with so many questions and answers. We can clarify your basic doubts about your financial planning, investments, and all of that. So to introduce myself, I am Saranya, representing Ashton Investments today. I'm more than excited to be a part of this webinar. As I said, it's happening on International Investment Awareness Week, so which has been announced by SEC in the US. So Ashton Gray being a US real estate company, this awareness week is, we wanted to spread as much awareness as we could so that you have a wonderful investment journey. To know more about Ashton Gray, you can very well visit www.ashtongray.in to know more about the US real estate investment opportunity that we are offering. So let me take you through the purpose of this webinar. So I should say today we have gathered here to discuss one of the most critical aspects of finance, which is investment. Whether you are a seasoned investor or someone who is just exploring the world of investments, I'm sure this webinar will be a valuable learning experience to all of you. And for that, to justify my statement, I must say I'm very much pleased to introduce our speaker for the day, CA Mr. Prabhu Swaminathan. He's a distinguished chartered accountant and a financial expert with a wealth of knowledge and experience in the field of investment. And as a founder partner of S.P.P Co. Coimbatore, he has successfully guided numerous individuals and corporates in their financial planning and investment. So today our CA will be sharing his insights on how to empower your financial future. So people get ready for this exciting webinar, and with no further delay, let me welcome Mr. Prabhu Swaminathan. He's here. Hello, sir. Excuse me, sir, 1 minute. Yeah. Please go on.
I'm audible now?
Yes, sir, you are.
Thank you, Saranya, for inviting me to this wonderful interaction. Let's not have it as a monologue, let's have it as a dialogue. I'm also happy to be part of the program. And I'm happy to share some of the knowledge and experience that I have, limited knowledge and experience that I have in investment and guiding our clients into the investing and the saving, all those aspects. So I'm really happy to be part of your company and also your team. Thank you again.
Definitely, sir. Thank you so much. And on behalf of Ashton Gray, we extend our appreciation and gratitude for your presence today. Thank you.
Thank you very much.
Great. So I would like to start the conversation by quoting the current economic situation, which seems extremely challenging and seems like making investment decisions during these times can be so overwhelming. So considering that, and to embark on International Investment Awareness Week 2023, we recently conducted a poll in our social media platforms, and we asked people to share few questions whichever comes to their mind when they think about investments and financial planning. So we got so many responses and we have consolidated few questions among them. So if you could allow, let me shoot out those questions one by one, sir.
Yeah, please.
Great. So the first question is from a young investor and he has just started to explore the world of investments, I guess. So the question from him is, what is the difference between saving and investing?
It's a very good question. And I think many of us, in fact, do not understand the difference, basic difference between saving and investment, particularly more with respect to investors in India. I think many people abroad, outside India, have a pretty much good idea about what investing and savings is. See, fundamental difference is saving is that whatever you earn, you just keep it the money in your bank account or in your FD. FD is also in some terms I have not said as an investment. It's a saving only because you keep the money as it is and you don't do anything with that money. That is savings. You keep it in your S.P.P account or current account, whatever accounts you maintain. That is a saving. But when you put the money in some kind of an investment, let us say in gold bonds or gold, physical gold, or you put in mutual funds or equity markets or in real estate, REIT kind of things, investments and all, that is where the color of the money forms changes from savings to investment. And that is what we are actually supposed to do also, because keeping the money idle in the bank, you'll only have, you'll not be even beating the inflation mark. Actually, some of my just might say that the money in your S.P.P account will be giving a 5 to 5% at the most. Some of the banks give 5%. Most of the banks give only 4% returns on your S.P.P accounts. And you might think that the inflation is only 6 or 7%. So we are almost catching up with investment. That is not the fact. Whatever investment, whatever the inflation rate that we normally get to hear from the published records is only 6 to 7%. But normally, when you actually faced in the reality, it is nearly 9 to 10% is your inflation rates. So if you keep the money only in your S.P.P account and savings bank account and current account, you're not actually increasing your wealth. Your wealth is almost decreasing. It's not even increasing. So that is where the investment is more important. And savings is mostly a financial aspect. You see, whatever you earn, you keep it in your bank account. That is where the saving ends. But investment is not alone financial. There's a lot of decisions that you take. For savings to do, you don't have to do much of planning and all. You just keep the money in your bank. That's where the thing ends. But for investment, you have to do a lot of thinking. You have to talk to a lot of people, read a lot. And it is not alone financial. It is also a business decision. For example, health is also an investment. Education is also an investment. So investment takes multiple colors, and everywhere you'll have to think, plan, and act. Only then, that is where the basic difference between saving and investment comes.
Very true. That was a detailed explanation, sir. Thank you. So when we talk about young investors, nowadays I see so many people are jumping into stocks and cryptos without even a proper knowledge. And they don't even know to manage when the market goes down. What are your thoughts about that, sir? And is there any particular tip that you can give to them so that they can keep that in mind before making investment decisions?
No, you'll have to continuously keep on updating yourself with all the information that you get from the public, whether it's a newspaper, economic newspaper, or a TV, where TVs like CNBC, or wherever information is regarding that business decisions are being taken. It's all published. We have a lot of public quarterly returns are being published over the company's quarterly publications coming, annual publications coming. All those things we'll have to read and learn and discuss with people and discuss with consultants. See, investment nowadays, it's not an individual that can do. You'll have to have a consultant. You'll have to have an advisor, a team of all those things will help you understand the market realities. And it's basically a learning experience. How much you learn about investment, that much better is for the current terms. It's not the earlier days when you just put the money in equity market, you forget it 5-10 years, the money multiple. It's not the case like earlier days. Now you'll have to discuss, learn, and unlearn also.
Correct. I think that's a fair point. Great, sir. So the next question is, how to determine the risk tolerance and what is the impact it has on my investment choices?
Risk tolerance.
Risk tolerance,
yeah. So risk tolerance is the amount, how much risk you can take after you make an investment, whether there is a market downfall, whether you want to again come out of the investment or don't, at what stage you want to come out, what stage you don't want to. This is the risk tolerance. For example, it depends upon person to person. It's not fixed for one person all the time and not for all the persons at all the time. Every person will have a different risk tolerance at the stage of investment where they are. See, generally what I would say, I would suggest is, see, in the earliest stage of investment, there are two stages of investments. Earliest stage means earliest stage of the life of investment, and the early stage of life of the investor. So both the things has to be taken into account. So earlier stage, your risk tolerance has to be really low. Whenever there's a small downturn in the market, and if you foresee that the downturn is going to be a very long term, then it's better to come out as early as possible. But later in the years, once you do an investment for, let's say, 5-10 years, and you're also in the later stages of your investment life, your first life, that stage your tolerance level has to be really high, because you cannot come out that easily and find out a better option that time. So that is where the tolerance level plays. So in my opinion, it all depends upon your current stream of income, what are your investment goals, how well you're placed in the other, your return of investments, and other, how diversified you are in the other investment portfolios. That is, all these parameters has to be taken into account when you're deciding into your risk tolerance level. But my suggestion is, you'll have to keep on updating about what investment you have made, what returns it's making compared to the other investment that you have made, how easy it is to come out, and what is the cost of coming out. All these things has to be taken into account.
True.
So clarifying your doubts.
There are few investment options, for example, like Ashton raised, where I must say almost all the risks have been eliminated before an Indian investor is onboarded. So I think a little research about the nuances of a particular product will help you with a better risk tolerance is what I guess. Yeah, that was a great answer too. So the next question is from a homemaker, interestingly, and she wants to know, what are the common mistakes to avoid as a new investor?
Common mistakes, I would say you'll have to start as early as possible in your investment life. See, let me say, if you're starting a professional life or a employment life by the age of 25, 26, the year one of your employment or your professional life, you have to start investing. That many people in India, we don't look into investment as an earlier option. We think that is a really long time for us to invest in. So that is one thing we make a mistake. The day one, we'll have to start. In fact, when we get an employment or into a practice or into any other profession, the first thing you'll have to do is we'll have to forecast our income. And from the forecast, first thing we'll have to do is to plan the investment. Rest all things has to follow. That is one thing as an Indian investor, we are not really looking after. And one more thing is, we think for investment to happen, we need a very big capital. That's not, it was all in the early days were like that. It's not like that anymore. Even a small fraction investment can happen. For example, the investment that we are making the Gift City or AIFs and all, it's not necessarily allowed to have very big capital to start investing. Small investment can, mutual funds, for example, chit funds, for example, small investment can happen. So that is, we think the mindset of thinking that it's have to be a big capital. And see, as to the last question we were talking about, the risk tolerance. Whenever there's a small downturn, immediately we hit the panic button. That is also not necessary. If you have made a very studied investment and studied planning of the investment, then I think we can still have even there's a small downturn in the investment, I think we can still wait for the market to turn good and then wait and reinvest. And sometimes when the market is turning bad, that is when we have to invest. That understanding is lacking in many of the Indian investors. Then now there's a small downturn, we immediately will pull the button and everything is taken out. Yeah. That is also one thing. And diversifying is not one thing that many Indians do. We always put all the eggs in one basket, whether it is real estate or in a gold or a mutual fund. We don't diversify. That is one thing I feel personally from what I'm saying.
Absolutely, yes. So our next question was about that. So somebody has asked, what is diversification and why is it important? How do you see how important is that, and how can someone diversify their portfolio basically?
It's in fact, in the investment life, it is the most important thing that you have to do is diversifying. The rest all things will follow. The most important thing, because each investment will have its own return of investment, risk factors attached, and liquidity aspects involved, and growth aspects. Many things for different investment portfolio. So, for example, in a real estate, sometimes you will feel that the growth of investment will be really high, but the liquidity will not be there. And there will be a lot of capital gains attached whenever there is a sale of that asset. The capital gain tax will be much higher compared to stocks. And the liquidity, if you take, for example, a fixed deposit where the liquidity will be high, but the rate of return of investment will be really less, 5-6%. That is what most of the bankers are now paying. At the most, I think 7 or 8% now. And equity markets, that's a little risk factor attached to it. Whenever there is a global crisis or domestic crisis, the stock markets fall, and you tend to lose a lot of investments. So all those things, if you diversify your portfolio, sometimes the market will perform really well compared to the gold or real estate where you get a better return of investment. Also, you have better liquidity also. So all these parameters, that is why we say the diversification is the best thing that you can. But initial days of investment, it will not be that easy for you to diversify because you'll have a limited capital and you'll have a limited option also. And you cannot do fractional investment in everything. For example, in real estate, you cannot do a fractional investment. For a small real estate, so you'll need a lakhs of money. So it will not be that easy. But fractional investment can happen in mutual funds or bonds or stock markets. And the capital, the returns that you take, you can take the returns and put it in some real estate. And short-term funds, you can park it in a fixed asset whenever there's not, when the markets are not really doing good and when the real estate is also not doing good, so you can park the money temporarily in a fixed deposit. So that is where the options of diversification helps as an investor to grow.
True. So I think diversification will very well resonate with Ashton Gray's product too. We can invest a part of the portfolio in the stable and regulated US market. Yeah. So when we speak of diversification, I also have a question about global investment. So a gentleman is particularly asked, what are the advantages of global investment and how it can benefit my portfolio personally?
Global investment, I say, see, till the advent of this COVID, we in our Indian operation, we never had the options of going global and all. With the gift city that has come up at Gujarat and where your Ashton Day, they themselves have come up with the alternate investment group. They have the options of investing in gold because we cannot invest in a company like Amazon or Microsoft company. So these options are being brought up only with this global diversification proposals like the gift city, AIFs, and global real estate. Sometimes what happens, the reason for going global is sometimes the return of investment is much better than in other countries than in India because of various other factors. For example, I'm told that somewhere in the real estate business in US, you almost get 20 to 25% annualized returns. That is not the case in a real estate market in India. So you have an option of taking the global pie, and also that is how the global investors have been growing, and we have been not given the options. Now that the options have come, I think we can better go for global opportunities.
Yeah, and I think when you want to go global, I think, for example, like Ashton Race, we are a vertically integrated company where this company has a total control of the vertical. So I think that will add up a security point of view. From a security point of view, that will add values, what I guess. So the next question is how to assess the performance of my investment and what metrics can I use?
So metrics is a very big aspect that we'll have. But as a retail investor, as a domestic investor, a simple Excel sheet with all the investment details that you have with this, what kind of investment, your diversified investment portfolio, date of investment, what is the returns, periodic reporting of the investments, return on investments, you'll have to make a note of it, and you match it with the inflation and match it with the goals that you want. See, most of us, what we do is we don't have a goal for which we are investing and there will be different goals. For example, I might have a goal for investing to close my housing loan at a particular point of time for the education of my kids or whatever it is, or a different kind of goals for diversification of my business. So it has to match with the goals. And we'll have to see at the end of n number of years, what is the return that I have to get. And we'll have to match every time the returns that we get. That is the best metrics that we can do. And periodic review of the investment. That is the best thing we can do.
Fair. Yeah. So let me shoot up the next question. And it says, what is the current development in the investment world and how can I be aware of the trends?
As I told, media is the biggest, because we cannot go and participate in each and every meeting in global investors meet, whatever. It's all for big investors and big portfolio investors. We cannot, media and discussing with your friends and peers and reading literature on the investment, on the latest investment on the whole world. That is the best idea to know about what are the investment trends and globally that is available.
True. So I feel like private equity is gaining traction nowadays. Is that so? And how do you see that, sir?
Private equity, they tend to focus more on technology and high return investments only. So far, what has happened is in India is private equity, they do not mobilize any capital from India. What they bring the hedge funds or the retirement from US or Canada or Australia, and they invest in Indian companies. And some 5-6 years back, only big projects were being funded by the private equities. Now they have started funding small startup units also. That is a good trend that we have. If any of our friends and clients have a very good idea of requiring any private equity, the choice of getting private equity has become actually very easy these days. So,
okay.
But as Indian investors investing in private equity, that option has still not come. Just now it is coming. It's not dull, well versed so far. I think in near future, a lot of options might come up for Indian investors also to invest in private equity firms.
Definitely, definitely, sir. So next question, I'm sure being an expert in tax strategy and all of that, you're the right person to answer this question. It says, how can I minimize my tax liability?
Tax liability, I think as an investor, we should not always be worried about the tax liability, Saranya, because whenever we make an investment, we'll also factor the cost of tax also, like cost of operations of the funds or cost of management of the funds. We'll have to factor the tax also. And not always, sometimes what happens when there is a need for a fund, not always we'll have to sell the investment. We can mortgage the investment and take a fund and invest in a business, and that can be claimed as an expenditure again. Your investments will also be protected. You will not be paying any tax on the sale of investment also. And so like that, multiple options are there. It's not necessarily allowed to sell your investment and take the money, pay the tax, and then invest again. You can borrow based on the investments. And then again, that cost of borrowing also can be claimed as an expenditure. And again, you can reinvest in your business. Those strategic plannings are really needed depending upon person to person when it comes to tax planning. And most Indian tax laws, mostly long-term capital gains are almost it's one of the least tax brackets available in India. So from 10 to 20% plus the surcharge, that is the least taxation. So whenever there is an acute need for selling of any investment, if you go for if you sell the longer term assets, then you save on the taxes. That is where that's the basic fundamentals of tax planning as far as investments is concerned.
All right, got it, sir. So covering up all these topics, I want to touch one more important topic, and that is about financial scams that's happening around. So how can someone protect themselves from falling victim to those companies?
Financial scams are not new, actually. It has been happening from times since immemorial. But the thing is, the investors have to see, they have to keep the eyes and ears open whenever they listen to some propaganda or some advertisement about sometimes what they're being lured with a very high rate of returns and all, which they have to fundamentally understand how that particular investment is possible to give that much returns. And huge number of advertisements, unnecessary advertisements, and they'll have to see the background of the investors, and they'll have to question the investors and the advisors who are coming to lure them into the investment, how the money is going to be invested, where it is going to be invested, what is the security that they have with the investment, all the background of the promoters. See, at least 5 to 6 years back, you'll have to go behind the period of investment and see what the investors has been doing, what is their background, what is the asset backing that those people have, the credentials, all those things has to be really studied. And then, because an investor is the fundamental fulcrum, the fundraiser is the fulcrum of the investment. If he is actually okay, then I think everything will fall in line. Fundamentally, the person who is raising the fund itself is not having a good background, is having a dubious background, or it's very opaque. Then I think it is better to avoid such kind of investment. And you'll also have to ask them what will be the reporting mechanism of that investment, how frequently they report on where the money is being invested, what is the returns, and they'll have to see what is the exit strategy for all those investment, whether it is being offered. The feasibility of the investment done by the company also has to be looked into. So if all these factors are looked into, I think we can protect ourselves, and that is what I personally feel people have to take care of all these things.
Definitely. So asking so many questions and being
one more thing that we'll have to add is we'll have to see what are the registration that they have, where all they have been registered with, for example, S.P.P or RBI, where central government or state government, wherever there is depending upon the fund, nature of the fund, wherever they've got all the approvals, necessary clearances, all those things has to be seen. All those documents, they're allowed to ask for the documents from the investors, keep it in a file, and the documentation also has to be really done properly.
Definitely, this should help. So the next question is about, we were mentioning about financial goals few times in our conversation. So the next question is how to create my investment plan that aligns with my financial goals.
That also is again very subjective question, Charlie, because it depends upon person to person. See, as a very young person like you, when you are starting your professional life, your goals will be totally different. A person who's at the age of somewhere 45, 50, his goal will be different. So there is no fixed plan for a person or any person during the term. One thing is, you have to keep on investing. That is one single principle that I will have to keep. There's 80% of, if you ask me personally, I will say 80% of your income has to be invested, saved, and out of it, 90% has to be invested. That formula, if you can have it in life, always in the life, then I think you everything will fun. And as I told earlier, there has to be a goal for the each kind of investment. Suppose, for example, I need to build a very big commercial complex in a land that I own somewhere, and I'll have to invest in a little bit higher rate of interest, and I have to have a plan for that. And if it's for an education, then I have to have a different plan. And I think most of the other investment advisors would have already told. See, insurance, I don't advise as an investment plan, because insurance is for your, it's kind of a fallback. Whenever something bad happens, it is fallback for your family or your debts kind of thing. But insurance is not always a good investment. So that one thing you will have to keep in mind. And one more thing is, debt is not always bad. If you have a very good business plan, and if you have a very good plan where your return of income, return of investment is going to have a good return of income, you can borrow and make some investment, particularly in businesses, not in investment, I feel in businesses. So it's not that always debt is bad. Unproductive debt, for example, buying a housing loan or a car loan, that is where the question of debt is being questioned. It's not a productive, but debt is always not always bad. That is the only thing I'll have to say.
Definitely.
And your investment has to have the maneuverability. You'll have to easily switch on from one asset to another asset as much as early you're possible, because that is where it will help you to grow. You should not be stuck in one particular investment throughout the life, throughout the period of your investment. That is where you have to be careful enough.
Definitely, sir. So with this answer, we come to the end of the questions. Over to you now. Is there any particular tips, or before I consolidate, is there any particular information you want to tell to our audience on a special note?
I think covered most of things, but as I told earlier, the investment, there is no, actually, you have to keep on investing. There cannot be any stoppage whenever there's a downturn in the market. You have to have a fixed plan, and you have to follow with the plan and start as early as investing. Don't delay the plan of investing. Definitely. And you'll have to discuss with a lot of your, see, we generally tend to have a very bad idea, particularly in India, where we don't discuss about our investments with the friends and relatives and family members. I think that is not that correct in my opinion, because we'll have to discuss with your peers, friends, consultants, and see what are the options that are available. Sometimes we might be knowing that one aspect of a gold ETF, but the other aspect we might not be. If the other people opens up the idea, we'll have to explore that idea. So different ideas get explored when we discuss. So the discussion has to be kept open, and documentation of all your investment, that is to be done very properly. Whatever you've been making investment, that you'll have to make very, and that is one thing I like to add. Pretty much, I think we have most of the things we have covered.
Definitely, sir. Thank you so much for taking time to answer all of our questions so patiently. And I'm sure this session would have been insightful for so many people. Thank you.
Thank you very much, Sonia. Thank all for the patient listening. Thank you.
Definitely, sir. It's our pleasure. So as an ending note, I want to consolidate 3 major takeaways from this webinar. One is to all the participants I'm saying. So one is, we encourage all of you to continue educating yourself about the market and trend. Second is, never hesitate to get professional advice from experts whenever you need. And the third is, remember to stay focused with your goals, because investment requires a lot of patience. So thank you, every one of you, for joining us today. And we wish you the best in your investment journey. Thank you. Thank you, everyone.